members, please go through this disclaimer. And from the previous two talks by Dr. Patel and Dr. Parekh, everyone in the hall, including me, is convinced that mutual fund is sahi hai. But then why am I here? This is the number of demat accounts opened in August 2024. And out of that, almost 40% of the account openers are less than 30 years of age. Second, direct stock investment is very exciting. And I am sure after this session is over, no one will go to Dr. Patel and Dr. Parekh, but will consult Dr. Surya sir. But please remember that in investment, whatever is exciting is not investing. We must also remember this. Everyone knew that there has been lots of investment fraud has been going on, lots of Telegram groups, lots of WhatsApp threads, and this is what is happening when you are investing in a stock market and demat account. What is this? Easy to invest, at the same time people can lure you and they can loot you. Another thing is this, what Dr. Gaurav said, that we try to come up with these superstar investors. So whatever they will buy, we buy. Whatever they will sell, we will sell. This is not going to create wealth. This is basically wealth destruction. So it is important how not to destroy our wealth, because that is also the way to create a wealth. So with this backdrop in mind, I am going to discuss certain things about wealth creation through stock investment or wealth. Now please remember the basic difference between direct stock investment versus mutual fund. We need demat account and own the assets along with the demat account. It is cost efficient if you invest through a discount brokerage, but you have to do it yourself. There is no professional manager. Minimum amount is high. In ML you can invest with just 500 rupees a month. But in stock, because you are going to invest in number of stocks, you cannot start with very low amount. You have full control of selection and hold. So you can decide which stocks to buy for how many years you have to hold. It is more volatile than the mutual fund because there are very less number of stocks. And here, unlike mutual fund, when in hybrid mutual fund you have a mixture of equity and debt, you have all is equity. That means whatever we are going to discuss here is for long term and not for short term. Another important thing is to understand the difference between investing and trading. Today we are going to discuss about the investing part. So we are going to take this smooth blue line of investing. That means we are going to invest in years. We are going to invest in a value by various fundamental principles and with proper risk management. So investing in direct stock is a process. It's not just a tip that someone says you just buy the stock and you just go for it. So we need to do a sector selection by NSE website. We are going to take a top-down approach. Then we select stock by certain methods. We are going to manage our investment and tracking and doing investment via Google Sheet. And there are certain rules of exits. So to create a portfolio, NSE website is a Gita for all stock investors. So you go to NSE indices, where you are going to find two broad sectoral and sectoral indices. So if you choose a Nifty 100 stock indices, which is covering the large cap stock, you will get the bifurcation in sectors. There are more than 14 sectors, but try to choose the first 6. Why 6? Because they are consisting of almost 75 to 80% of stocks. And from that, from the below sectoral indices, you can select which sector you would like to invest. So suppose we are going to choose a health sector, then you are going to get the top 10 health sector company. I think you can see the companies, we all are familiar with it. Same way you can choose with IT, oil and gas and banking, all the sectors. So what we have essentially done in mutual fund is Dr. Patel said there are more than 900 schemes. But in stocks, we have more than 2,000 stocks. So by doing this, we are just filtering into only 60 to 70 good companies which are on the top, which are fundamentally good companies. We divide whatever amount we want to wish equally into the all sectors. So see, I am investing in 6 sectors and my plan is to invest 60,000 rupees a month. I will assign 10,000 rupees each to each sector. So there will be equisectoral distribution. So once we have decided how many sectors, the next question will come often, how many number of stocks. If you see this graph, you just invest in one stock, then there are almost 30% chance their whole capital might get wiped out. So ideally, you need to invest across certain number of stocks, and as you increase the number of stocks, beyond 30, the risk is not going to go down. So ideally for us, it is the 6 to 18 is the good number. If we are going to go for a 6 sector, then minimum 6 stocks, maximum 15 to 18, because at the individual level it will be very difficult to track so many companies. And once we select this many stocks, then we have to analyze each stock with fundamental analysis, and these are the parameters we wish to see. Like textbook, though it has been described under quantitative and qualitative parameter, but in practice there are so many ratios that it will be very difficult for us, because we are busy in our medical practice. So we need a comprehensive method which is easy to understand and implement, which is less time consuming, and it is effective. So we have developed indigenous method of drop and pick to select stocks on basis of fundamental analysis. This is called non-banking and non-finance stocks. Basically, as safer, it is a mnemonic. So in drop, it consists of D for DE ratio, R for ROC, and then various growth parameters. What drop does is, at the name suggests, if the stock is not passing through this criteria, then you just drop it. There is no point in investing. And if it is passes through this criteria, then you just analyze it further on the pick criteria, on valuation and other things. And this we do for the period of present year, past 3 and past 5 year data through a website called Screener. It is difficult considering the time constraint to discuss the whole method, but if you go to Screener and when you search any company, say Cipla, there are these 9 ratios on the main dashboard which is by default. So they will come anyway. The next 18 we can adjust as per criteria we choose. So this is the drop criteria. If you can see, the debt to equity is 0.02, the ROC more than 10, profits are more than 10, sales growth is more than 10. So it is pretty easy from the single snapshot that this company is fundamentally good or not. And pick you can find in the above line. So P is for profit and loss and balance sheet, C for cash flow, I for investors, C for chart, and even the company website you can see. So the Screener is a very handy and useful website. The free version has lots of benefits. And just see, this is the other company, Vodafone Idea. See the return on capital employed -3. And there is no return on capital, there is no point in investing. You see the sales growth, it is hardly 2%. The profit growth is negative. So by just looking at this screenshot, maybe in 3 to 5 minutes, you will be able to know whether this company is fundamentally good or not. And the same has been replicated in its price. If you see, if you have invested in say 2014 at the price of 120, today the stock price is around 9% or 10%. It is going to be the biggest wealth destroyer. So it is very important to start in a good fundamental company, and with drop and pick criteria you can easily able to find that. So when you combine that with the metric, with the set, probably you are going to get a good company. Another good feature of Screener is you can see lots of screens. So in the popular stock screens, if you write finviters, these are our screens which you can get it. And we have categorized companies into 3 categories, like risers, stockers, rankers and rock stars. So if you click on risers, then you will get these companies. Only 120 companies pass through this all criteria. And you will find Cipla and you will not find Vodafone. So it will be very easier also. So from a sectoral analysis, you just say 10 companies, and when you run this Screener, and if you find it, then you are rest assured that the fundamentally company is good, and then you just have to need to see valuation and requirement. Keep around 15 to 18 stocks per family. Many times what we see, Dr. Inson has 10 stocks, in VIZAG there are 15 stocks, and HUF has 10, and median number sometimes 40, 50 stocks, and they are just adding it. That is not going to create wealth. So keep your large cap stocks. Out of that, take in around 10 to 12%, mid cap 4 to 5, small cap 2 to 3, and with the individual 5% for large cap, 4% for mid cap, and 3% for small cap stocks. It may not sometimes possible to start in all 18 stocks at a time. So like I said, in the first year of your investment, you can start with 6 large cap stocks. Then you are comfortable with the valuations and volatility of stock market. Then in second year, you may add 3 large cap, 2 mid cap, and 1 small cap. In the third year, you can get 2 large cap, 2 mid cap, and 2 small cap. This is the way to go. And try to invest from the reputed stock houses. Investment via systemic monthly plan. It has to be for more than 7 years. Review annually. There is no need to see stock prices every day. And increase by 10% every year. So if I am investing 60,000 in this year, from next year I may increase it to 66,000 or 70,000 as per my income. We need to do adjustment. We know that the stock market is volatile, going higher and up. So whenever you buy a stock, sometimes you buy at a higher level, sometimes you buy at a lower level. And say after a year or 2 years, there will be some average purchase price. And after 2 years, your stock may be either at the upper level or at the lower level. So if you have a, like in this example, in M&M, suppose you are on the greener side. So your buy price is 900 rupees and to the current price is almost 3.5 times. So ideally you are supposed to buy say around 1 or 2 stock with the 5,000 rupee allotment SIP per month. Then instead of 2 you buy 1. So you will not overpay when the stock is very high. And like the Kotak Bank which is running down almost 15% from whatever your average buying price. So ideally you are supposed to buy say around 2 stocks and buy more when it is low. So that way you are trying to just giving some value investment also to your stock SIPs. It has been said that this knowledge is only 20%. If you need a wealth, you need good robust psychology. So investment psychology is very important in stocks. I think people has this fancy of finding 100 beggars. But please remember the math behind 100 beggar return. So if you are expecting a 40% year-on-year return, still it will take almost 14 years to get a 100 times return. Dr. Surya sir has been just telling to us that if you buy Tata Steel in 1980, now you can imagine what is the compounding and what is the percentage of return he has. So it is important to remain invested for the long time. There is no point in buying 100 beggar stock. I think we will be happy to buy a 10 beggar stock because that is going to create wealth for you. And another thing is patience. Patience is very important. This is the Reliance Industries chart. And if you see from 2010 to 2018, the return is not very high. It is just remained subdued. The price has been 400 to 800. But after 2018, you can see now it is almost 3 times. Don't mix it but with the Vodafone Idea chart. That it has been going down. Here if you are saying that the previous part has to be either stable, not decreasing. So do not check the price regularly, opt for all corporate actions, reinvest the dividend whatever you earn, and calculate the portfolio return and not on an individual stock. Sometimes we try to love with certain stocks which has been giving us good return and we just try to ignore those who are not doing well. Planned exit, you all know when the goal is near. There are certain times in stocks we have to decide ourselves for the unplanned exit. When the promoter is running from the company, there is no point in we will stick to it. And there are certain corporate governance issues. And when there is 50% drop from your average purchase price, you have been SIP in any particular stock, say for 3 years, and your average purchase price is 200 rupees and the stock is trading at 80 rupees, there is something serious has been going on. And you have to just evaluate, and if you think it is not comfortable, better to exit. Is there any limitation? Obviously, because it is a very focused portfolio of 15 stocks in the limited and part-time research done by non-professionals, and we know that fundamental parameters are derived from past data and may not guarantee future. So to summarize, doctors, if they want to invest in direct stock, they have to remember 4 Ds. First, invest in a diversified portfolio of 15 to 18 stocks. Use discount broker. Do it yourself and find a method. Drop and pick is one method, but there are lots of other methods which is comfortable to you. Do in a systemic monthly manner. Always do for the long term. And please remember, building wealth is a marathon. It is not a sprint. So the 4th D, discipline, is the key ingredient. Thank you very much.